Okay, let's take a look at problem 7.2, and the gist of this problem is our job's going to be to create journal entries, record the transactions to show how they would be reflected in the government-wide financial statements. So we know that with government-wide financial statements, we're dealing with the full accrual basis, not the modified accrual basis. Now, again, we know that the initial transactions will all be recorded into a general fund, which is that modified accrual basis. But for this purpose, it's asking us, how are we going to report these on a government-wide basis? So we know then we're going to have long-term assets, and it tells us in A that the district opted to depreciate its infrastructure assets. So there are times when the infrastructure, they can choose not to depreciate them based on certain conditions, but they're telling us that they will be depreciated. So let's take a look at this exercise and work through this together. Now, in this year, a road maintenance district was established, and it engaged in these transactions related to capital assets. It received authority over roads previously owned by the county. The estimated replacement cost of the roads was $60,000. On the average, they have a remaining useful life of 40 years. So how would we report this on the government-wide financial statements? We would start by showing an asset for infrastructure of 60. Now, I know these are supposed to be in terms of thousands, but we're just going to keep it simple. And then we're going to show a net asset under the guise of capital assets. We could treat this as a revenue or initial contribution, but the bottom line here is this is an increase to our net assets of $60,000. So that's how we would record that initial entry. Now, as we go back to the number 2 journal entry, or I should say event, it acquired machinery and equipment for $700 with general fund resources. They have a useful life of 10 years. So again, we're going to record an asset of $700, and we would show a credit to cash because we used money to purchase that machinery and equipment. Once again, long-term assets get recorded in government-wide statements. Next, we incurred cost of $3,000 to construct a building. The construction was financed with general obligation bonds. The building has a useful life of 30 years. So the initial cost of $3,000, we know from learning that even in for-profit, all costs pre-construction and during the construction get capitalized. Costs that include the architecture fees, any permits, all the expenses for obtaining financing. And while the construction's occurring, even the utilities get capitalized. So in this particular situation, those initial cost of $3,000 get capitalized, and since the construction's going to happen through bonds, we would credit bonds payable of $3,000 to record that construction in the works. Next, we've got acquired equipment having a fair market value of $60 in exchange for $20 cash, plus used equipment for which the district had paid $50. The used equipment had a fair market value at the time of the trade of $40. Depreciation of $25 had previously been recognized. Now, this is probably going to be the most challenging one. It did acquire equipment worth a fair market value of $60, but this was a trade-in. Therefore, when we are dealing with trade-ins, we don't recognize gain in this transaction. We record that new equipment based on what we actually paid for, or the exchange that occurred. So we know the cash was $20. That was what we also call boot that was paid. And then we want to take off the books the piece of equipment we traded in. We have an adjusted basis on this equipment of 25 because we originally bought it for 50, but with our depreciation of 25, its adjusted basis is 25. So if we get rid of that old machinery off of our books, we get rid of the machinery, get rid of the accumulated depreciation, we would then take our cash plus that adjusted basis of that old equipment to come up with 45 as the basis for our new equipment. Again, when you're dealing with trade-ins, you don't recognize a gain here. We just treat the new value gets recorded at the book value of the old equipment plus any cash that was involved in the trade. Next, we sold land for 70 that we acquired for 90. Again, this is just going to be like for profit in the government-wide. We will show that we received 70 in cash. We will take the land off the books of 90. And as a result, we're going to have a loss on the sale of land of 20. Next, we're going to see that we've received a donation of land from another town, and the land had cost the town 120, but at the time of the contribution had a fair market value of 500. Well, in this case, we will be recording it as the fair market value land, and then we're going to have a net asset increase or revenue. Ultimately, the effect is an increase in net assets, recording that donation of land. Finally, we're going to talk about road resurfacing costs. It incurred $1,200 in road resurfacing costs, and the district estimated its roads need to be resurfaced every 4 years. Again, we're depreciating our infrastructure, so what we will be doing here is using this road resurfacing cost as an improvement to our roads. And so, therefore, we will report this as an improvement or asset to our roads of $1,200, credit our cash for $1,200 because we are opting to depreciate our infrastructure. Then it asks us to record the depreciation. Again, we're dealing with government-wide, so we will show depreciation of $100 on the buildings, $70 on machinery, $1,500 on the roads, plus anything for resurfacing costs. So as you'll see, we'll have a depreciation expense. We'll be crediting all our various accumulated depreciations. It gives us the roads, building, machinery, and equipment. And we know with the road resurfacing costs, it tells us to amortize that over 4 years because that road resurfacing will last for 4 years. So we'll take that $1,200 and divide it into 4 years, which gives us $300 each. You can continue on to understand or go through part B and C in this, basically as far as under the modified approach. If they were not, let me just go back here. Suppose instead that the district elected not to depreciate roads but to record it as an expense, only the cost necessary to preserve the roads in this condition they were when acquired. How would the entries differ? And you can see here, if that would be the case, it would expense the resurfacing costs because they wouldn't have been depreciated. And then if we look at C here, if in fact the roads had a useful life of 40 years, do you think it is sound accounting not to depreciate the roads? Well, this is no different from for-profit accounting or fund accounting. If the roads have a useful life of 40 years, it really should be amortized or expensed over the life of the asset, because truly those roads are losing some of their worth or value each year just by the wear and tear on those roads. So I want you to review this again. make sure you pay attention to the study guide. You're going to have 2 problems on the quiz, and you have similar problems addressed in that study guide. And I will be here to answer any questions that you have. Feel free to email me.